we're going to be in chapter 4, and what we're going to do is we're going to review the statement of retained earnings just to kind of see, the way we did the assets equal liabilities plus equity. We want to start there. Then we're going to go back and we're going to do an exercise where we're going to look at some accruals, which we talked about last time. So just in general, we know that assets equal liabilities plus equity, right? And we've always talked about the order of financial statements. That would be going from the income statement to the statement of retained earnings to the balance sheet. And specifically, what part of the balance sheet? The equity section, right? And we know that it works, but we want to make sure that we have a little way to get to that there. So what we're going to do is we just really briefly, we'll start off here with the income statement. And what all goes on the income statement? Revenues and expenses. We'll show the subtraction of expenses, okay? And that equals our income. Now, just a general way that we do the retained earnings statement will be the beginning retained earnings. And what will we do to the beginning retained earnings? We'll add or subtract it. Add it, because we usually expect to have a gain. Now, if we have a loss, we will subtract it, but in this case, in most cases, because we have a gain, we will add our income. And then it's our company, remember, so we're going to reward our investors by paying some what? Dividends, and we're going to add to that because we're paying, or we're going to take away? Take away, good, okay, so that's a less. That's dividends. And we'll end up with our ending retained earnings. And then we have our balance sheet, and it's, of course, assets equals liabilities plus equity, but I'm going to move this right here so we can see something here, which is our equity, okay? And how do we increase equity, with the debit or with the credit? With a credit, good, okay? So we increase it with the credit. Now, all we have to do is instead of just, you can't just transport there, right? So we're going to put it in a tiny little car and send it over there. That tiny little car will be called what? It's a certain account. Income from last time. Income S. Summary. Income summary. We're going to put the expenses in the car. We're going to put the revenues in there, and then we're going to take it over there. Now, let's think of this way. Do revenues increase or decrease equity? And this may be a little bit new, so let me talk you through it. Remember, we're going income statement to beginning to retained earnings to equity. Does retained earnings increase equity? It does, right? Because retained earnings is everything we have not distributed, whether it is mostly through dividends or if before the income got here expenses. So if we did not distribute it, then we're going to increase retained earnings with the credit. Okay. Now, does do revenues increase retained earnings? If we add it here, then which part of this adds to the income? The revenues or the expenses? The revenues. So we can say that we increase our equity by increasing our revenues. How do we increase our revenues? With a credit, okay? All right. Now, expenses decrease our income, right? So, do they decrease our retained earnings as well? Since we're putting them in there, they're going to decrease retained earnings too, right? So now, just thinking about it, if revenues increase equity and expenses decrease income, which decreases retained earnings, where do you think the expenses will go? On the equity, on the negative side or on the positive side? Or on the debit side or the credit side? Debit, that's right, okay? Now, all we have to do is to put everything over there. When we go from here to here, we're going to go and we're going to do journal entries to go from here to here and then to here. We want to get this income into here, but we're not going to use income to get there. We're going to do what? Close these out or zero these out. So we're going to do that by doing what? By zeroing out revenues first, then zeroing out expenses, and then we'll be able to put it in that car called income summary and drive it over here. So let's think. We increase revenues by crediting them, right? So if we want to zero it out or get them all the way, how do we do that? With a debit or with the credit? Remember, we increase it with a credit. So how do we decrease or how do we put it in the car? With a debit. That's right, okay? So let's just pretend this is our piece of paper here. And so once again, we increase it that way. So to decrease them, we will go this way. Now, what's the name of the little car they're going to get in? Income summary. Good, okay? And so now, we're zeroing out, we just put whatever it is. That's what income summary. All right, what about expenses now? Watch how I say this. Expenses decrease equity, right? Expenses decrease equity. They decrease them with a debit. So how do we zero out our expenses? By doing what? The opposite, which is to what? Credit. Good, okay? And what account or what car will they get into? This one right here, same one. So let's put them in a tiny little car. Income summary. Everybody's in, ready to go. Where are we going? We're coming from the what? Income statement to what? Retained earnings, right? So let's think about it. Which one will I debit or credit? Which one will I debit or credit? Let's think of it this way. Retained earnings increases over here, right? With the credit. We agree? So since more than likely we're going to have an increase, then will we credit or debit retained earnings? We're going to credit. I think we have credit. We're going to credit it. And let's make sure we remember why. We're going to credit it because crediting retained earnings shows an increase. It shows an increase in what? All of our leftover income. This is our leftover income from prior periods. This is the income that we just made this period, and we pay little dividends out. Everything that we do, we're going to put it in here. Okay? So basically, this actually goes right here. It's just we put one line there, with one line here. Okay? And just maybe to make this clear, this is actually going to be your ending retained earnings in the end. Okay? Yes, ma'am.
So I noticed that, like, under the equity, it has the revenues and has the retained earnings, and on the other side has the expenses. But on there, it has the revenue as a debit, but you have the expenses and the retained earnings as a credit. Does that mean the expenses is a lot more than the revenue and the retained earnings is?
On this side right here? Okay, on this side, what we're doing is we're trying to take our income and put it in our retained earnings. But we have to do it piece by piece. So if I'm taking it from one place, I'm going to be left with how much? With zero. So in order to zero it out, what I would have to do is, since I normally would increase it with a credit, I have to decrease it with a debit. Is that okay?
I'm just not understanding the connection from that and what you have over there.
Okay, which part? This here?
Like, you have both the retained earnings as and the revenue as a credit.
Right.
And the expenses as a debit.
Right.
But the revenue and the retained earnings there, the revenue is a debit and the retained earnings is a credit on there.
Okay, think of it this way. This would be your chapter 1. Let's isolate this. All of this is chapter 1 that before we ever knew, well, for the most part, but definitely before we knew this right here. By this being chapter 1, when we were in chapter 1, every time we did a service and we collected revenue, did we always credit revenue to show an increase?
No. Yeah. I don't remember.
That's okay. It's gonna come back up now, and actually we're gonna talk a little bit about that today. But it's gonna come back up. but it's gonna be a little bit more like times 2 because we're gonna deal with the unearned revenue, which is gonna be a little bit complicated, not complicated, but an extra step. Let's say an extra step. So every time we did a service, most of the time you will see something like billed so-and-so $300 for computer expenses or for computer services. Those services, we would increase the services with the revenue with the credit. And when we say billed, did we actually collect cash? Instead, we have an expectation to receive cash, which was a debit to accounts receivable. So we would debit accounts receivable, expecting to get that cash and credit our revenues. That's a small example. Or if they paid us on the spot, we still would credit revenues and we would debit our assets to show that we actually received it in. So over here, this is our, I said chapter 1. This is our chapter 1 and chapter 2, and then general interest in chapter 3 right here. Now, all we're doing in chapter 4 is we're saying, how do we actually get this number right here? This is all we want to show in our balance sheet. It's going to have one small piece, which is income. So how do we get there? We go from our revenues, and we have to zero them out by doing the opposite. Since we increase everything on this side with a credit, we decrease it with a debit. Since we increase our expenses, because remember, it's an increase in expenses, but it lowers the equity. It's an increase in expenses, but it lowers the equity. So this minus sign is related to the decrease, the effect on equity. And the opposite would be done here to get rid of it. And now everybody's is in the car, but we want to see which side of the road the car is going to drive on. So we know that retained earnings is going to always be increased with credit. We agree on that one, right? So since all this income is increasing it, we're going to continue to show a credit right there. But what about income summary? It's got to drive in this lane over here. Because if we think about it, though, that we use just regular numbers. If we have more revenues, if we have more revenues than expenses, then we have to do the opposite, okay? So our income summary would be right here, okay? This is only if we have a gain. If we have, let's say, positive income, okay? That's the key word, positive income. All right. Is everybody okay with that? And so that's the pattern. Now all we do is we just go fill in our numbers. So sometimes you may see something like, it'll have all this writing up here. And all this writing would basically say, not in this case, but it'll say, we have beginning retained earnings of $0. What should the ending be? Then you may have to do a balance sheet or something like that to get it ready, and that'll get your, not a balance sheet, do a portion of the balance sheet and an income statement to get it ready, and that's the number that would be. So we see, all we have to do is, to get this, we need to have our revenues, must. We're going to have that. We had that the other day. You're going to have some expenses. You must have that to have an income. Since we know we're going to retain earnings, this is the third piece we will have, retained earnings. And we must also pay dividends. Let's talk about the dividends. Do dividends increase or decrease retained earnings? Let's say it differently. When I pay my dividends, right, is it showing an increase to retained earnings or is it showing a decrease? Which one is it? Decrease. A decrease, right? So we're going to keep this here, and since we know it's going to be a decrease now, we're going to put that in light red or something like that or whatever. And since it's decreasing, remember, dividends will go here. Excuse me. Dividends go here. Why? Because they're not increasing revenues. They're not increasing equity. They're decreasing equity. So when we pay that dividend, we're going to, since we know we're doing it, retained earnings is going to go down. So we're going to debit retained earnings. And when we debit retained earnings, let's think past the debits and credits, right? When we think past debits and credits, to debit retained earnings means that we are decreasing, we're losing, we're paying out something. Any of those terms are okay because it may be a decrease due to loss. It may be just a loss for some reason or another, or it could be a payment. In this case, it's a decrease due to a payment. So when we say debit retained earnings, what we're saying is we're decreasing our retained earnings. It's going down. Our retained earnings is going down. And that's okay because we work with people. We want to get paid, right? So when people give us money to invest in our business, we may give them a little something. I say may because if the value of the company goes up, that's a different type of payment. So either they're hoping to get a return on their investment with the stock, the ownership going up, or they're hoping to get a dividend. And it just depends on who that person is. No right or wrong answer. It just depends on who they are. But every time we say debit retained earnings, we're saying we're decreasing our retained earnings, okay? And we're doing that because we're paying dividends. And those are journal entries. These are your closing journal entries. And that, I just want to put it up here for us again because we know we went over it, but we still want to make sure that we lock it in the same way that we did our assets plus liabilities plus equity, which as we go, don't ever forget that. We're going to use that a little bit more probably next time, but don't ever forget that, okay? Because that's going to be the key to everything in here when you get lost. I'm glad if you can memorize these things, but sometimes you may have another test or you never know what's going on. But having that to fall back on, as having this to fall back on, is going to always help us. So when we show a credit to retained earnings, are we gaining or increasing retained earnings? Let me see. Are we gaining or increasing? All right. Are we losing? No, we're not. But if we debit retained earnings, we are losing, right? Okay. So that's going to be the key. And of course, everything else centers around there. But now we know how to take it from here to over here. We know that now, okay? And of course, once we get this income summary, this goes away. So just to kind of highlight, to make sure we keep our little color scheme there, that's going to take care of that. This is taken care of right here. They're all in the car, and the car is going to go right here. One more thing, this is probably not relative, but it may help you out. This is for this year only. Let me say, this reporting period. If we're doing it for the month, then from the last time we had retained earnings to now, we have to do it. If we do it once a year, from the last time we had it to now, we must do it. You probably won't do it every week, but if you did it every week, this is only for the period that we cover, okay? So that's going to be the difference between beginning and the ending. Monthly, weekly, more than likely it's going to be monthly at worst, okay? I say at worst because it's not even at worst anymore. We don't have to do this in real life, but this helps us to understand how all of this works right here. So you'll probably never do that, even if you have your own business with QuickBooks or whatever they're using now. Well, I still use QuickBooks, but if there's something new that comes up in the future, you're never going to do that. It's going to do it all itself. But like anything, when you know how it gets there, it's a little bit helpful in explaining probably to your lending institution why you like to do business with them. Okay. Everybody feel good? Okay. And any problem you have, let's just think. If they give you beginning retained earnings, right? And if they give you the ending retained earnings, what two pieces are you missing? Just these two, okay? If they give you the income, if they give you this and this and this and a whole bunch of accounts, let's just say they give you revenues and 3 expenses, then you know that all we have to do is to compute our income and we'll place it here. But if they say, how did we get here? And obviously the questions are not phrased that way in our homework, but this is what's behind it. How do we get there? We get there through using these journal entries, okay? Everybody feel good so far? Well, we will continue. We're going to go to some accruals, okay? All right, so let's talk about accruals. Why do we do accruals? If you and I have a transaction right now and I pay cash, there's no need for an accrual. Why? Because you're going to give me something, I'm going to give you some cash in advance or vice versa. If you go to a supplier and you pay cash, the supplier could be Walmart, the supplier could be one of the industrial companies. If you pay cash, they have no need for accruals, you have no need for an accrual, okay? So what is an accrual? An accrual is something that takes into account the effects of cash before cash is exchanged, okay? So accruals they account for cash before cash is exchanged. Notice, account before, all that's on that side over there. Accruals have to do with accounting for cash, dealing with cash, recording cash before, timeline before cash is exchanged. Obviously, if you are a business, you're selling to me, we're talking about receivables would be a type. If you're paying, you're talking about you will have a liability, okay? So this deals with cash before cash is exchanged. Once again, if you give me something now and I pay you cash, do you have to worry about accruals? No. If I say I know it's just if you give it to me right now, we're getting real technical, but this is really, you'll never do this in real life, but this is what it is. If I say I will pay you when class is over, if you go to your books right now, do you have an accrual? Yes, because I did not give you cash right now. So anytime you do a transaction, when your utility bill, your car note, your rent that you know is going to be due next month, if you have not paid it yet, you have an accrual. Only if you're going to do some income statements and stuff before the end of the period. So anytime cash is not received, is not exchanged, you're going to have an accrual. Okay? Let's just kind of look at this for a second. We have, we're talking about supplies, we're talking about services, and we're talking about rent. So we're just going to take those three only because it's here. We're going to come back, but we're just going to take those three for a second, okay? We have assets, always going to come back here, equal liabilities plus equity. All right. Let's start with supplies. Let's say that I buy supplies. It's a debit, so I put it on this side. Let's just say I buy $1,000 of supplies February the 1st. You okay with that? I buy supplies February the 1st, right? Now, let's just say once again that all of these are the supplies, right? But I'm going to take some of these supplies out and use them. I'm using them. Let's just say I've used them and they're ready to go to the garbage, so they're totally used up, but whatever it is, this was my supply room. This is my supply room. I took some out. I bought those on February the 1st, right? Now, as of today, do I still have the same amount? Do I still have $1,000 worth of supplies in here? No, I do not. Now, think about it this way. Did I just go buy these? No, I didn't just go buy these. I bought them earlier. But even though I'm using them up, I'm not exchanging the cash. I didn't have to go to Walmart or Office Depot. I didn't have to go anywhere to get these. I got these out of something there where cash was used previously. So once again, Accruals always have to do with using something, using things, or excuse me, accruals always have to do with transactions where cash is not changed. This is a little different example, okay? But and I'm going to give you another one, but all of these are related to there. But this says that I buy this right here. So on let's say this is February 1st. Now we're going to do our income statement. Let's just say we're going to do an income statement for February 28th, okay? At the end of the year, at the end of the month, let's say I don't use anymore. So let's just say at the end of the month, I have $900 of supplies left. So I took this out, I still have $900 of supplies left, right? So you go look in there and you start counting. 100, 200, 300, 400, 5, 6, 7, 5, 6, 7. I have $700 worth, excuse me, I had that right the first time. I have 900 left, okay? I have 900 left. If I had 1,000, I have 900, what happened to the ones that was in there? They're used up, they're gone, right? So if they're gone, I have to make a journal entry, not for cash, but for what I use. That leads us to another definition. Now, this is not the complete definition. It's a part of one that we don't talk about a lot, but it really helps us out. An expense. The simple, easy part. An expense is the using up of assets. Okay? It's the using up of assets. So an accrual is accounting for cash before cash is received. An expense is a using up of assets. There are other things that go with it, but we're just worried about the assets part right now. So we agree. I used these up. I used up $100. We agree with that, right? How do we record that? Well, if I go back to our first module, if we increase our assets with a debit, then if I use up my assets, what am I going to do? Credit. So let's say if I don't use anything else, we'll just put like it's the end of the year, end of the month now. So at February the 28th, I'm going to show that I used up $100 of supplies with a credit to supplies. Okay? So does that make sense? All I'm doing now is just showing us in the income statement how it happened. Najee, you okay with that? Okay. So all I'm doing is showing this up. It's just showing us in the books where I did it. Now, let's go back to the last module. Is supplies an asset, liability, or an equity? It's an asset, right? And we've already agreed that we're going to credit supplies for $100 because my assets have gone down. That is the supplies, okay? So I credit now. And what I need to do is to find me a place to come over here, and we're going to do the journal entry. So I simply just take that from there, and this is going to be a credit to supplies for $100 to show I used supplies. Now, with every credit, there must be at least one what? Debit. So what am I going to debit? Let's think about it. An expense is a using up of assets. There's more to it, but for right now, an expense is a using up of assets. Do we agree? What's the easiest way to keep up with it? Just call it whatever it is. If I use supplies, then use supplies expense. Debit supplies expense. The using up of assets. What asset? Supplies. Okay? Supplies expense. for $100. You see, all of this shows the expense portion, okay? This is the asset portion. So I had $1,000 of supplies at first. I've now used up 100. At the end of the month, see, all I can do is just go, I'm just saying, if we want to do this, I can go in there and look and see, I'm gonna have $900 worth. I already know that this is used up. Now, I don't know what it's used up for. Somebody could have used it, somebody could have stolen it, it could have dried out. I don't know why, but it's gone. I have to put that in the books that it's gone. I do that by removing some from there. Like I remove these from here. This journal entry is saying I removed $100, somebody removed $100 of supplies from there. And that means I have an ending supply amount of how much? $900 or 9 markers. We're good in that part, right? Now, since I did that, I have to show that in the books. This says that $100 worth of supplies have been used up. And I'm going to, $100 worth of supplies are gone. My supplies, my asset supplies are now decreased. And to show the debit part, to show that I used up an asset, which asset supplies, then I have to put that debit there. And the last big thing about accruals, everything else is going to follow this method, okay? The last big thing about accruals is every accrual has at least one income statement account, and at least one, I want to say balance sheet because there are other times it can be different types of balance sheet accounts. So at least one balance sheet account, at least one income statement account. If I was to check my work, would I ever, if I was looking at accrual, if I had an accrual question and I didn't know nothing else, would I choose something that has 2 balance sheet accounts? I would never choose something that has 2 balance sheet accounts. If I didn't know the answer, would I ever, for an accrual now, not adjusting, but for an accrual, would I ever pick something that has 2 income statement accounts? No. We can have 2 income statement accounts and one balance sheet. We can have 2 balance sheets and 1 income, but the answer will never have all balance sheet accounts. It will never have all income statement accounts because an accrual must have at least one of each category. How does everybody feel? It's new, okay? And it's one of those things where it kind of feels like, it feels really good, but then if we literally just like go outside the door sometimes, it may be a little bit different. That's really the reason that we have homework. That's why I give you specific homework and not just a bunch of stuff. You see what I'm saying? I know that sometimes you may see the same question 2 or 3 times, but it just puts you in a different mindset. It may be a different change in name or something, but when you go to the testing center, you can say, I've seen more than one type of problem. And when we give, remember, you can't ask a question in so many ways. I can put a bunch of fluff in there. That's not going to really do anything. You're still going to be so smart. You're going to figure out exactly what you need, and I just wasted time making a weird question, right? So it all comes down to one or 2 things. This, in general, is what we have. Now, I know I use assets, but the same thing we're going to see is going to apply to everything else. When you're dealing with accruals, you have something that happened before. I'm not going to say the beginning, but something happened before. You have something that is current, and your accrual is going to account for the passage of time. Everything that happened in between that's your accrual. This journal entry, it happened between February the 1st and February the 28th. How do I know that? That's this right. That's this right here. This happened between these two times right here. Okay, just different ways to think about it. Because it's easy to be like, well, no, it's not easy. It's actually more difficult to say, remember to debit this, remember to credit this. But when we understand where it's coming from, when we get stuck, that'll kind of help us out. So the accrual happens between sometime before and sometime after. That's what the accrual does. And the accrual always has at least one balance sheet account and at least one income statement account. Never all income statement accounts, never all balance sheet accounts. Okay? This is for supplies. To me, this was always the harder of the ones. So that's why I want to do that one first. The other ones are pretty much the same, but if we get this one, or as we start, by doing this one first, to me, the other ones are a little bit easier, okay? That's just what I've seen with me. So I don't want you to make the same, or have the same troubles I had, okay? Can we try another one? Let's try the next hardest one. If it's a hard one, no, let's just try the next one, okay? I'm going to erase this, but I'm going to come back and make us get in the habit of thinking about it again. All right. So accruals. Accruals. They account for cash before, key word, before cash is exchanged. Okay? So when I went and bought those, when I used up these markers, I didn't go buy these markers, even though it's slightly, you can say after, cash was not exchanged when that actually happened, okay? What's the other thing we need to know? We need to know that an expense we're going to say that an expense is the using up of assets. And we just did that one, right? We just did that one. The other part is, or the occurrence of a liability. You don't have to know these examples, these definitions for the exam, but it's just one of those, but especially with supplies, and maybe with unearned revenue, but especially for supplies, it will help you if you get stuck on something. So now we're going to talk about unearned revenues. Is unearned revenues a liability or an equity account? Liability, right. Let's just think, how do we have give me an example of why we would have an unearned service revenue. You can make up one.
You did a job for somebody and you haven't paid yet?
I did a job for somebody and haven't paid yet. Can I switch that around a little bit? Let's say that I'm supposed to do a job for you and I haven't done the job yet. It's the same thing you said, but I want it to be that, I want to make sure that I say we, but I know you're taking the exam, so I'm going to say you. That's the only reason I'm saying you. I want it to be that so that when you go in the exam, you say that, look, this is my company. I paid, one more time. This is your company. I want you to say that I gave you some money, right? I gave you some money to, what's your major?
Cybersecurity.
Cybersecurity. I gave you some money to get me the best cybersecurity system. That's the wrong way to say that, really, but to give me the best cybersecurity system, because the best cybersecurity system means I can't even use the internet, right? So you can't really lock it down. But let's say the best according to my needs, right? I paid you in January. You're going to be finished by the end of the year, okay? So I gave that to you. At this point, remember, this is your company, so that's why I have to put it in that way, okay? At this point, if this was the beginning of the year, on January 1st, had you done anything for my job, for my computer? Nothing at all, right? I just gave you the money up front. Whatever deal we had it, okay? So I give you the money up front. So you will receive cash. And we know that we show a receipt of cash with a debit, right? For how much you need?
30,000.
30,000, okay? You know that's accounts receivable. I'm not giving you $30,000 up front, right?
It was worth a shot.
Huh?
It was worth a shot.
Hey, that's fine. You know what? Since I didn't give it to you up front, let's use another one. Accounts receivable. Doesn't really matter because it's actually both of them. Well, I won't use accounts receivable. Technically, you can't use it. So, I mean, technically you can use it, but for what we want to do, I'm going to have to give you $30,000 cash for this journal entry, okay? Because we're talking about cash. I like that. Yeah, that's right. Now, you did not perform the service right, and it's no fault of your own. I mean, I paid him up front. I trust him, so I paid him up front. No problem. Under any circumstance, he's going to credit $30,000. We agree with that, right? It's just a matter of what account it will go into. We know that it's going to be some type of revenue. But what type of revenue? Is it earned or unearned? Has he done anything yet? So he can't say he earned it right, so it would be what? Unearned. Okay? Now, not taking this literally in terms of before it's exchanged, but understand this right here. Even though I gave it to him, when it's time for him to perform that service, let's say January is already paid. Let's just say February. February. Now you want to start putting this in your pocket. Before we keep going, I want us to remember that unearned revenue means that if he does not do it, it's a liability because he still either owes me the service throughout the year or he's going to give it back. But he wants to get to where, hey, he can say, I can use this now. Okay, I can use this to further the business, to pay my employees, maybe buy myself a little something if that's okay to do within your company. So you want to be able to use this for whatever you need to use it for. You can only do that after you've done something. So this is for 12 months. Just to make it easy, for 12 months, okay? And 30,000 divided by 12 months, about what, $2,500 a month? Okay, about $2,500 a month. So, after the first 2 months, how much, well, first, let's think about it. Today it's not, but today is February 28th, right? So we can say that he's earned, out of 12 months, he's earned how many months' work? He's done work for how many months? 2 months. So he can record 2 months of revenue, right? Now, we know that part, but before I write it up here, once you do that, do you ever want to make the mistake of thinking that you still owe me some money? You'll never want to make that mistake, right? So you must also adjust the liability account as well. So 2 things are going to happen, okay? The first thing, he is going to, I would say first, this is what I would do. I would reduce that liability. Even though I haven't paid it yet, or I haven't paid it yet, I'm going to get that off the books. I don't want to pay someone twice. So I'm going to now debit earned revenue for $2,500. And this shows that I no longer owe for 2 of the months. That's what that shows, okay? The debit to the liability shows that I don't owe that liability anymore. If it's utilities payable, I don't owe for 2 months of utilities. I've done that, okay? So in his case, cybersecurity, everyone's working for a cybersecurity company. So this is two months worth of liability that is no longer owed. He can now go. I apologize, my math is wrong. It's 2 months. It should be $5,000. Okay, $5,000 because 2,500 times 2 would be $5,000. Okay, so there's 2 months that he does not owe for. Everybody good with that? And now he can record some revenue. That is so nice. Everybody good with that? Now, one thing I'm just going to kind of throw out. Remember now, as of now, he still has $25,000 cash in his hand. So, if you get cash in your hand, if you have to use it for another project, he may need to use it for a project for someone else's project. Please go further and have more accounting records if you do that, okay? That's one of those situations where you know you're gonna do it. You're insured probably that you're gonna do it, so if something goes wrong, you're not worried because your insurance is gonna pay for it, and I'm still gonna get mine, so you're okay. But if you do that, just make sure that you have enough for what you need it for, okay? Those are things that sometimes we, as small business people, we may run into that. Sometimes accidentally, oh, it's in the bank. The bank doesn't have a face attached to each dollar in there. We have to remember that through good accounting records, okay? And that would probably say revenues dash Wilson, unearned revenue dash Wilson, to specifically tie it to my job. So you have way more revenue accounts than just one. This is just a collection, okay? This is everyone's company collected in there, but everyone has an individual name or company, so that's why we'll have that. So are we okay with why we're doing this journal entry right here? Okay? Now, let's go back to some of those things we talked about. If I don't know nothing else, I know that I need to have I know that an accrual should have at least two types of accounts. At least one income statement and at least one balance sheet. Let's check and see. Now, the accrual was set up here, and obviously the journal entry was set up, and this actual accrual was right here. But to adjust that accrual entry, we have at least one balance sheet account, because that's a liability, so we can definitely say that's a balance sheet. And we also have at least one income statement account. So at the very least, I may not be right, but I'm on the right path. You know what I'm saying? I'm on the right path because I'm at least in the ballpark. I know I need to have at least one. You may have a mixture, but you can never have all balance sheet accounts and all income statement accounts at one time. That can't happen, okay? So just to kind of go back over it. If you receive cash up front, we can take sports, okay? You buy your season tickets, right? This season tickets is for a game a month, in this case, a game a month, okay? I'm not paying $2,500 for that, but $2,500 for a game a month, okay? Now, at the end of 2 months, they can now record 2 months worth of revenue. I don't know how, this may be one game, this may be 15 games, I don't know. But now they are giving me what I paid for, 2 months worth of games, and now they can record the revenue by removing the liability and by now showing an increase in their revenues, okay? And we started, how did we start? We started because, look, we had something that happened at the beginning, at a time prior, and now we're making journal entries at a later time. And stuff that happened in between, this is what happened in between. The accrual here is what happened in between. This is what happened from the beginning. This is what happened for the time passed between the beginning and where we are right now. Now our books are correct. Good. Quick question. Now we're going to make sure, once again, it's those things to double check. Now you'll have some of these problems in your homework and on your questions and on your exam as well. But let's just say that I forgot to adjust unearned revenue, or I did the wrong account. Whatever it is, I still have $30,000. If I forget to make an adjustment to this liability account, is this showing that I owe more, or is it showing that I owe less, or showing the right amount? It's February 28th. January 1st, I had $30,000 in here, in this liability. I know I owe $30,000. You can look at it as dollars, or you can say, I know I owe 12 months of service. This just, whichever way you want to, 12 months of service or $30,000. I like to think of the service and deal with the money later. If I see $30,000, that tells me I owe 12 months of service. We know January passed. We know February passed. As of February 28th, how many months of service do I owe? Do I owe in the future for the rest of the year? 10, right? So if I forget to make this and I look at it, that's still showing I owe 12 months worth of service, right? Remember, accounting is not just about putting the money down, it's about telling a story. It says that somebody paid me for 12 months worth of service. It's today. I don't see this. Let me go back to the last journal entry. Oh, I still owe 12 months. Now you overworked yourself. You could have booked your staff incorrectly because you think that you need to do 12 months worth of service in 10. So you schedule all these people for overtime, right? And it's good for us getting overtime, okay? But he's paying a little bit extra money. we at the job, you know, just having a ball, right? Because there's nothing to do. You see how that can go wrong if we forget. For accounting purposes, we're gonna say this is overstated. It's overstated if you do not make the entry. But from a practical standpoint, it's showing me that, look, I still got to do all this work. When in reality, if I had done this, I would clearly have a balance of 30,000, which is 12 months, minus 5,000, which is 2 months, and it shows that I have 10 months of work left to do. If I don't make this journal entry to my liability, my liability will be overstated, showing I owe more than I had. Everybody good with that? Let's go back to supplies for a second. I had $1,000 worth of supplies, and I took out one, so I have $900 worth. So at the beginning, this is what it looked like, 10 months worth of supplies. Okay, even though I took one, let's just say that this is the one I took. If I took this one, but I was still showing this, are my supplies overstated? The beginning of the month, it should be here, but it's still there. It should be here, but it's still there. If I forget to take this out of a journal entry, then that's going to be over or understated? Overstated, because I forgot to make my journal entry. So if I fail to take my supplies out, it's going to be overstated. What does that mean? I may say, oh yeah, I looked at the books and it has enough money. We have enough accounts. We have enough markers. Okay, you didn't know I took one, right? Now, if you know I took one, there's more people that work here, and they probably took some. If that entry wasn't made, it tells a story that says, look, oh, we have no supplies, we're good. And then you start seeing people can't do their job, we're all out. So if you're an accountant, make sure that doesn't happen. If your accountant is there, especially if they're new, usually, you know, after a little bit of time they'll get it, but just make sure they realize the importance of that if you're training someone. You know, even in your case, if you have your own business, don't just assume they have it. I'm not saying you're gonna do, once again, you're not doing their work now. This is all the work you're gonna do in journal entries and stuff in this class. Maybe a little bit in managerial, but you just want to understand that when you look at the books, you may ask them, hey, have all the accruals been put in? You're just looking to see if they say yes or no, and what does it mean? That's what it is. That's all it means, okay? Everybody okay so far? All right. Let's look at this problem. We're trying to do this problem here, okay? We have unearned adjusted trial balance. We have unearned service revenue, we have supplies, and this is right now. Right now, at this date, we have supplies of $3,850, unearned revenues of $8,800, and prepaid rent of $1,650. Okay, this is what we have. I'm going to leave that up here this time. All right, so unaddressed trial balance means that this is what you were given. Okay, so it's February 28th. Remember, we did all this stuff. I used all these markers, right? I gave them the cash up front, but the balance sheet, income statement, all that stuff, it's not really showing us that until we update it. So I would like to think of this as the before part and the after part. So before I had supplies, I think it was $3,850. And I'm doing this on purpose. Once again, we want to just get a difference over here so we can do our work in the middle, okay? Just for the thought process. And I have unearned service revenue of $8,800. And prepaid rent. You see this abbreviation PPD, that's prepaid rent of $1,650. In terms of this right here, let's just say that means that you paid up your rent in advance, okay? And we know that when you pay up something in advance, that's your prepaid, and that's an asset, a current asset, cash receipt, cash, debt, investments, receivables, inventory, supplies, prepaid. This is where it is, okay? And so, thinking about prepaid, we won't go through the exercise, but with prepaid, if you paid it up at the beginning of the year, your rent, your mortgage, for all 12 months, as of February 28th, the imaginary date for the day, how many months have we lived in this place? 2 months, right? So I no longer have 12 months of paid rent up front. I mean, in my account, excuse me, I no longer have 12 months of prepaid rent paid up already, only have 10 left, okay? So that's what we talking about right here. In this case, you have $1,650, so we'll just say that's for 10 months, okay? Now, this is at the beginning. This part right here, remember, this is the beginning, what we just did right there. Now look right here, at the end of the period, later, after, whatever you want to call it, scoot over a little bit, have a little room. I just say later, okay? What am I going to have? I'm going to have $780 of supplies on hand, okay? I just want to kind of show that this is related, okay? I have $780. I also have services of $3,650 have been performed. Now, I started off with unearned service revenue. That means I received money, cash, and had not done any work yet. It's okay if you have a contract with that, okay? Now, by this saying that, look, I have services that had been performed to the unearned revenue account. If it's been performed, that's going to come somewhere here, right? How do we get from here to here? By stuff that happens in between. So at this point in time, the time in between I performed services of $3,650. Okay. So I perform that in between. This is what I'm doing is we're taking what we had, what we were given, and we want to make sense of it. Okay, so before, happened, and in between. See, with supplies, all we know is that we looked at the books. They showed us what was here. Let me put one more in. The last one is prepaid rent. It says that $550 of prepaid rent has been consumed. So $550 of prepaid rent is consumed, okay? There are many ways to do this. This is just a really simple way. If I write what happened before, later, which is right now, end of the period, and in between, I can figure out what is being asked. Does that make sense? We just want this organized to see. Remember, accounting is just about organizing stuff. You may literally organize it a totally different way as long as you have a system that always comes back to help you, okay? So this is just one of many ways, but I would say before, in between, and later. So, right now, let's kind of, well, we can't say we can't ignore this. We know this happened, okay? We can't ignore it. But we can say, look, let's figure out what my supplies balance should be. I start off with this right here, supplies. I have this much supplies right now, supplies. How much did I use up? An expense is a using up of assets, right? Expense is using up of assets. How many dollars of supplies did I use up? Forget dollars. Let's say this is 1 for 1. How many did I use up? How much did I use up? If you don't know the answer, how do you get that answer?
You subtract the 3,850 from 700.
You subtract the 2. And what's the difference between those? That's correct.
is 3,070.
Okay, so I used up $3,070 of supplies. Okay? I used that up. That's pretty, we knew it was a difference. Now we know what the difference means. It means that I use this up. Now, seriously, it could have been, like I say, the markets we could have bought some bad markets. They could have dried out. That's using it up. It's not that we use it, it's dried up. Somebody accidentally threw them away. That's still a using up. Now, there are different we're not going to those. You can have as many supplies accounts as you want for these type of things. But in general, it's showing they use up this many supplies, okay? Everybody good on that one? Now, we have a liability. We owe some people because they gave us some money up front, right? They gave us, see, we did cybersecurity last time. Who has a different business? Or wants to have a different business? Graphic design, okay? So you are going to design a logo for me, right? You know that you're going to have to pay that. You know that I paid that. So let's just say I'm doing it in stages. I don't know. This is you can divide that by there. That's maybe 40% or so percent. You're 40% complete. We're just going to say that. And by the way, this happens with construction. You get a certain amount over time. Okay, so you're 40% complete. So easy question. If your accountant is doing your books, if you look and see this at the end of the month, let's just say, don't write this down, but if we look at our books and we still see $800, what's going through our mind? I haven't even started this project yet. I got to get me some people in here. I got to work longer. That's what we're thinking, right? Because we're not worried about numbers, what the numbers tell us. That's what it's telling us. I got a lot of work to do. I can't go out. I can't talk to nobody. I got a lot of stuff to do. If we see this, that's what it means. It also means that my liabilities are overstated or understated if I do that. If I look up and see this, but if this is true, but I don't know this and only see this, are my liabilities overstated or understated? Huh? This way up now, this is what you need to do this much amount of work for me, right? Now, remember, you don't look at you out getting business. You don't do the graphic design. You come up, you go get business. So you depend on your accountant. All she or he is doing is giving you some books. They should have put this in here, but they didn't. Which means you still see this. So I have 8,800 of yeah. You see what I'm saying? Yeah. You got, and so it's if we change the dollars and think of them as projects, I have 8,800 projects to do. I still have 8,800 projects to do. You might fire somebody because you think they're not doing something. You see what I'm saying? So yeah, it's just that perspective part. So that means it will be overstated if this was here. Okay, that's if this was here. Now I'm going to erase this because I want to understand the over and understated. So I'm going to erase this. Okay, because the accountant did the right job, or the bookkeeper, whoever you have doing it, they did put this in here. So now, what should my balance be? How do I get this balance? It should be 8,800 minus 3,650. That's wrong. 7 minus 3 is 4. 4,150. That's how much I should have in there, right? I should have 4,150.
8,800 minus 3,650 is
5150. I told you I did it wrong. 5150. Okay? 5150, right? Thank you. 5150. That's the true balance. Okay? Prepaid rent. We paid up our rent, right? We paid up our rent. And it's kind of hard to tell. This may be 3 months worth, whatever. If I used up $350, 3 months worth for this 12 months, I should only be showing 9 months. I'm just kind of throwing it out there. So let's say that it is 3 months, so 1160, 1650 minus 550. I should show a balance of how much? Well, it should be 1100. I hope I'm right this time. 1650 minus 550. That's how much we should have, okay?
It is 1,100.
Okay, that's how much we should have. So we see how, if we just kind of just write a little chart on our paper, right? Before, well, before, after, and during, okay? Or as time passed. That's what we want to be able to do, okay? Everybody good in that part? So now, all we have left is the journal entries. If I had supplies, right, and if I used up my supplies, do I still have the same amount of assets on hand? No, right? So I need to reduce my assets by what I used up. So, in this case, I would credit supplies for, looks like this amount is $33,070. I will credit that amount, and I need to have a debit, right? Because I have a credit, don't need to have a debit. What are we going to show? An expense is a using up of assets. What asset did I use up? Supplies. So the logical choice would be supplies expense for the same amount. That's my accrual. Let's check it. We can't totally check it, but let's check it. At least one income statement account, at least one balance sheet account. I'm on the right track. If I'm wrong, I'm on the right track. If it's a multiple choice, that's what you're coming down to, okay? Everybody good with that? I have to erase it for space purposes, so is everybody okay on that one? All right. Now let's look at the next one. Unearned service revenue. I did services, remember now, I think this is the one we computed over here. We computed this one right here, so let me put a star by where we compute this and this, okay? This is what we computed. Now, I used up this much of the services. So, at the beginning of the year, excuse me, I don't want to say used up. At the beginning of the year, we had $8,800 worth of liabilities. To decrease my liabilities, do I debit or credit to decrease my liabilities? Debit, okay, that's right, debit. So unearned revenue is now going to be decreased and I've got my liability out of the way, so now I've earned some what? Some revenue. I've earned some revenue. Okay. $436.50. If I had not done that, then my unearned revenue would have been over or understated. If I forgot to make that adjusting entry, would it have been over or understated? Overstated. They would have said, oh man, I still have a lot of work to do. I still owe some people, but because I did it, I'm okay. One last check. Do I have at least one income statement account? Revenues, income statement account. Do I have at least one balance sheet account? I do. I met the criteria. An expense is a using up of assets. That's what we just did. Or it incurs liabilities. The liability was right here. See how the other part worked? So that part actually goes with this, okay? That's why we have these things, the liabilities portion is up there. So that's why you have to put both of them. Like I said, you don't have to memorize that, but it should make sense that, well, supplies was an asset, this is a liability part. So that's just kind of showing us once again that we're definitely on the right track. We know it's right, but if we didn't know it was right, this is how we would pick if we didn't have a lot of time. Got time for one more? All right. The last one we have is prepaid rent. Now, when we originally set this up, we paid out cash. We previously paid out cash of $1,650, and we recorded prepaid rent for $1,650. That was the original journal entry. Then, over the last period of time, since we've done it, we've consumed $550. So, remember, this was an asset, right? This was an increase in asset by the debit. So how do I show that I used up part of this asset? With a credit. So credit prepaid rent, all right, for $550. And what have I done? We know it's gonna be some type of expense, right? Expenses are, in this case, is this a using up of assets or a liability, or a current liability? Prepaid rent is a what? It's assets, so we're talking about a using up of assets. We're not gonna be tested on that, but it's just, you know, one of the things that we get lost. To show the using up of an asset, I wanna have some type of expense, and that expense will be called what? That's right, rent expense, okay? For $550. Sound good? Does that help you out with the accruals? This is, like I say, this is the one that's new, but after all of this, it's going to be fine. I have a video out there, and it kind of goes through a lot more journal entries. So if you go through that one, I think that'll be helpful. I'll post this one as well, but this is going to be helpful because you really want to get this down. Hopefully, do you see the importance of them? That's the biggest thing. If you get lost, just start thinking about scenarios. As you do these, use them with your own company, okay? Or with your own desired company if you don't have one. Do something that's personal to you. These are kind of general examples, but I think they kind of go with everyone a little bit. Hope everybody enjoys your spring break.